And on Monday morning, Appaloosa Management founder David Tepper made a big market call. He told me Japan, which had been a net seller of treasuries for years, could start buying U.S. government bonds again. Here to weigh in on that call and what else investors should be watching in the bond market is Peter Boockvar, Chief Investment Officer of Bleakley Advisory Group, CNBC contributor. Theoretically, if you had listened, you could, Amazon's back above 3,000. The NASDAQ was in the low 12s. It's back above 13,000. Dow's up 4 straight days. You could almost take profits based on that. But Boockvar, Peter, I don't know whether you're saying Tepper is wrong or has his facts wrong, or you have different facts. But he said that the Japanese had been net sellers for 5 years. You say that Japan's holdings of U.S. Treasuries are near record highs of $1.25 trillion, up $200 billion over the last few years, so they're already loaded up. So when he said they'd been net sellers for 5 years, he was wrong. He's looking at different information than you?
Yeah, they were sellers up until about 2018, and then picked up their purchases again. So Japan is now the largest foreign holder of U.S. Treasuries, surpassing China. China is closer to $1 trillion, and as you mentioned, Japan's at $1.25 trillion, which is only about $40 billion off record highs. So they still have a lot. Now, if there's a yield pickup to have, like David said, the Japanese are going to take it. The cross-currency basis swap, which is basically measuring the cost of hedging out that dollar exposure if you're a yen-based investor, has been pretty steady over the past year. So now with the widening gap between the U.S. 10-year and the Japanese 10-year, there is a yield gap to capture. I just don't know how aggressive the Japanese want to be with the amount that they already have. So every Thursday, they announce their purchases of foreign bonds. They don't necessarily split it up between country, but for the week ended March 5th, they reported today that they only bought a modest amount after selling $35 billion of foreign bonds in the 2 prior weeks. So while it's possible, we haven't seen it just yet. I think most relevant for bonds are what the Fed does with the banks and the supplementary leverage ratio, because the banks have been the big buyers of treasuries of late.
Yeah, I want to talk about that. I saw your comments on that. But just returning to Japan just for a moment, I wanted to mention this yesterday, actually, because we had the somewhat tame CPI numbers, and there were other things going on yesterday that saw yields fall on the 10-year. But Japan, some Bank of Japan officials seem to be not necessarily in agreement with Governor Kuroda, that was Tepper's thesis on Friday, that he said there's no reason to widen the band on keeping rates at 0 on the JGBs. But yesterday there was another official who said we need to raise the band. We need to let rates go higher. And they have a meeting on March 18th and 19th, Peter. Is it possible that they go against what Kuroda indicated on Friday and that they actually do widen the band?
I don't think yet. I think what they'll do is, and we heard this from the deputy governor on Monday, that they'll tolerate more volatility within it. The problem that the Japanese have with this band is that the Japanese bank stock index since 1989 is down 90% in nominal terms. They have literally killed off their regional banking system because of what they've done to the yield curve. So widening the band at some point is something they're going to have to do. But I think right now they'll try to do it in a very controlled fashion by first saying, let's have more volatility within it, and then maybe in the coming months start to widen it as growth picks up, as inflationary pressures start to increase, because they need a regional banking system if they're going to survive as an economy.
All right. So you worried here about the supplementary leverage ratio for banks and whether the Fed extends that. You said if they didn't, banks would be less inclined to do a lot of treasury buying. But then you go on to say the Fed would never do that. They will extend the waiver because the banks need it, and the Fed's worried about the implications for the treasury market. So you bring up the possibility of it happening, but then say it's not going to happen.
Well, I think if we didn't have this big rise in rates this year of, in the long end, 55 basis points in 2 months, I think from a regulatory standpoint, the Fed would just let it expire and the banks would go back to the ratios they had pre-pandemic. I think that now with the angle of, okay, there's been disruption in the Treasury market, and banks have increased their holdings of Treasuries and agency securities by almost $800 billion over the past year. I think that the Fed's going to want that bank lubricant to remain in the Treasury market for a next, maybe another couple of quarters or two. But they're getting pressure from both sides. I mean, Elizabeth Warren wants them to end this waiver, and then the bond market is saying, please extend it because we need the banks to buy more Treasuries.
Shepard Smith here. Thanks for watching CNBC on YouTube.